This undictated special podcast is brought to you by Futuregrowth Asset Management. Andrew Canter, who's the Chief Investment Officer at Futuregrowth, joins us now. Andrew, in the wake of the Abil disaster, there's been quite a lot of comment on various websites about retail investors losing money, getting letters sent to them from the asset management companies to say that the money they'd put into a money market fund is not 100% theirs anymore. It is something that happened in the United States some years ago. But let's maybe begin with this term, breaking the buck. What does that mean?
Well, let's go to first principles. Generally, when we talk about money market funds, investors tend to think of them as extremely low risk, if not zero risk investments. But in fact, they've always had risk. Inside a money market fund is a range of investments. A fund manager will buy a whole bunch of different bank NCDs. Sometimes they'll buy some short-dated debt instruments issued by large corporations and other financial companies. So you end up with a diversified portfolio. At any given time, let's say there's 50 different borrowers represented in a fund. Any one of those can go bust, and you can lose part of the capital. Now, they are short-dated instruments by law, and they are usually high credit quality also by regulation. So your chances of losing money are very small. And as a consequence, the daily unit price is usually held at 1 rand per unit or 1 rand per share, and you just get daily accruals. Now, what happens when one of those underlying issuers, in this case Abil, if you're sitting on a portfolio that has 5% exposure to African Bank, and African Bank closes doors and you lose that money, well, you shouldn't really be maintaining the price at 1 rand per unit for the fund, because you just lost 5 cents per share. And you should break the buck. You should be pricing your units at 95 cents per share, not one rand a share. Do you follow me?
And not too many people. I remember when in my previous company we had a big deposit with a money market fund, and we were not able to get a guarantee on the capital of that fund. And I see now why.
Well, that's right. I mean, it's an investment, right? In all investments, it's risk and return. So what is the risk you take in a money market fund? Well, I just said the risk is you've got a diversified portfolio of short-dated credits. Any one of them can get into trouble in any given day. Now, as we saw with Abil, you may have had 5% exposure, but in fact, by the time the Reserve Bank goes through, you're going to get back 90 cents on the rand. So in fact, your loss wasn't the full 5%. It was only 0.5%. So it's not a crisis. Your unit price, you would have lost 0.5% of the capital of the fund. Now, on the other hand, if you were an equity fund holding 5% of Abil, holding Abil shares, you just lost a full 5%. So again, risk goes with reward. Short-dated debt instruments are lower risk than equity investments or pref share investments. But the fact that retail investors are told that money market funds are risk-free is a little bit delusional. They're always a bit of risk.
What if you've got R1 million invested in your money market fund? You don't like hearing that 5,000 rand of it has disappeared.
Well, this is true, but on the other hand, if you had R1 million and you put it directly into an Abil NCD or a bank deposit, the possibility is that when Abil closed doors, you could have lost all of that money in the absence of the Reserve Bank stepping in. You could have lost your entire R1 million because it's not a diversified portfolio. Or with the Reserve Bank step in, you could have lost a full 10% of your R1 million, 100,000. In your money market funds, you only lost 0.5% or 5,000. So you see, the diversified portfolio is a buffer. And lastly, it's worth noting that by putting it into a money market fund while you pay a manager fees, always, that's what we get, you're probably getting a higher yield because asset managers are able to negotiate higher interest rates from the banks that they put money with. So you do get a slightly higher return. You do get a more diversified portfolio. And so that's the trade-off. There is risk, but it's not as risky as putting all of your money or all your eggs in one basket.
Andrew, if it is only that small, 0.5%, as you've explained in this example, wouldn't it be easier then to just carry that lower yield over the year?
Well, so yeah, that's the problem. It seems to make sense, and the fact is that the FSP will allow a fund manager to offset a day or two's interest accrued on a fund with capital loss, so you don't have to actually break the buck. But the fact of the matter is, these are open-ended funds. Clients can buy and sell units every day. So if Abil's closed doors on Friday today, let's say, and everybody knows it, and you know that the unit price of your unit trust hasn't dropped, everybody's going to seek to withdraw their money on Monday as soon as they can. While your logic is true that over the course of a year the interest will accrue and offset that loss, the fact is everybody will run out of the fund on Monday. So in an open-ended fund that allows people to trade units on a daily basis, you have to mark-to-market the assets and you have to mark-to-market the unit price, or else it's prejudicial to the unit holders that remain.
Now, the Americans brought in something called floating net asset value. How exactly does that work?
Okay, so in classic money market funds, they always hold the unit price at R1 per share or $1 per share in the U.S. And what we realized in the financial crisis, and what we realized in 2008, and what we realize now in the Abil crisis is that sometimes you can't or you shouldn't hold the price at R1 per share. And so a floating NAV would be something that allows the price every day to go up or down from minor changes in the capital value of the fund. Now, in the normal course of events, a money market fund would then trade between 99.85 cents and R1.015. You wouldn't even notice it. The float would be insignificant in everybody's daily life until there was a credit event, until there was some default of an underlying borrower in the fund. And then your unit price might drop to 98 cents or 97.5 cents. But that at least allows that mechanism to operate in a seamless, flowing way, rather than what we've seen in the past week, where suddenly it was, oh my gosh, I don't know what the price of my units is, and they look like the R1, but I can't get out, or nobody's really clear what's happening because the price isn't changing, and so you don't really know how to react. The floating NAV is a cleaner mechanism to transmit the message that there is risk in an investment, that it isn't guaranteed, but the merits of the product are sound, but the price can change.
Is that likely to be introduced here?
So in the U.S., what they've done is they've introduced a floating NAV only for institutional targeted funds that are sold to institutional investors, but not for retail investors. I think it's a very poor solution. I think it remains delusional that there is no risk, that the price is always R1 a share or $1 a share. And I do think a floating NAV should be introduced globally and in South Africa as well. There's various marketing reasons. Salespeople don't like it. They like to pretend that it's like competes with a bank account. You put a rand in the bank, it's a rand today, it's a rand tomorrow, and it doesn't change until the bank goes bust. so the salespeople of money market funds like that, to pretend it's always going to be R1 a unit, and they don't have any issues with that. But it actually, any asset manager worth his salt on the investment side knows that assets change in value by a little bit every day. They can go up or down, and you really should bring that through as truth.
You mentioned a little earlier that the Financial Services Board has allowed money market funds to take 1 day's interest to offset the capital losses. In most instances, is that going to be sufficient?
Okay, so first of all, I may have misspoken. I believe that the write-downs on Abil were taken on the Monday after that weekend when the SARB stepped in. So I think there was 3 days of accrued interest that the funds could use to offset the actual write-down on the Abil senior debt they took. Mm-hmm. And in many cases, that was enough to cover it. So you lost yield, but you didn't lose capital. The other choice that was made, and this is really extraordinary, is that rather than actually break the buck and allow the prices to move down to, say, 99 cents or 98.5 cents, is they didn't break the buck, they merely reduced your number of unit holdings. So yesterday, for example, you might have had 1,000 units at R1 per unit, and today you've got 998.5 units at R1 per unit. So we didn't change the unit price; we just changed your number of units. It's kind of a tricky way to accomplish the same thing without breaking the buck.
But people aren't stupid, and I've been, for instance, looking at Fin24. There were some concerns there from people at ABSA who'd found that money had disappeared out of their money market fund, and they didn't really understand why. The way that it was explained to them was not as simple as you have unpacked it for us here. I guess that's part of the problem. The marketing guys want to keep the illusion that this is safe, but in reality, it is there is a risk attached.
I think you've hit the nail on the head. My view is you in any investment fund there are risks. Sometimes assets go up and sometimes they go down. To maintain a fixed price is delusional, and they should have just changed the unit price. The mechanisms weren't easily in place to do that on a wide scale across the industry. I do think that as we look back in 3 years' time, the illusion that they never broke the buck will be maintained, where you and I and those unit holders who have lost units on that day will know that they lost money, but that will be hidden to posterity. It's a terrible thing, I think.
There's a lot of money tied up in money market funds as well, 270 billion by the last count. So Abil's demise in the initial instance was thought only to have affected those who invested in the shares directly, but that isn't the case.
So I think we mustn't lose sight of the role of the money market industry. So what I said earlier was money market funds invest in a wide range of bank paper, of short-dated commercial paper from corporates, and they do create a competitive force against the banks having monopoly and oligopoly on lending. So they are a positive factor. It's a way for investors to disintermediate the banks and make direct loans to corporates through their asset manager. That's a good thing for the economy. It creates a more efficient capital market. They are diverse funds, so you don't have all of your eggs in one basket, one bank. You do pay a fee, but you end up getting a higher yield. So yeah, the industry is big, and that's we're talking about a serious bank failure here, and the losses suffered in money market funds. Actually, we are talking second decimals of losses in those funds. We're not talking, my gosh, the client's pension has been lost. We're talking, fractions of percentages for most of the funds and investors.
So it does carry a risk, but on the other hand, you get a reasonable yield, or a far better yield than you'd be getting for a deposit, perhaps directly with the bank.
I think that's right.
Andrew Canter is the Chief Investment Officer at Futuregrowth, and this undictated special podcast was brought to you by Futuregrowth.